We have explored the historical debt traps, the madness of crowds, the decay of empires, the destruction of fiat money. But the ultimate debt is the one we take on for shelter, the mortgage. We are not here to scare you with anecdotal headlines. We are here to conduct an unflinching forensic analysis of the global financial architecture, and it leads us to a single, unavoidable conclusion. The housing debt crisis currently unfolding across the globe is not a repeat of 2008. It is structurally, geographically, and financially bigger than 2008, and the consequences will be far more widespread and difficult to contain. The Great Financial Crisis was a failure of quality low-grade subprime lending localized primarily to the American and European banking systems. What we face today is a crisis of scale and rate of change, a highly synchronized, high-quality, high-principal debt bomb set off by the fastest central bank rate hikes in 40 years. If 2008 was a regional fire, this time, the entire world's housing market is standing in a common field, and the spark has already landed. To understand the scale of this threat, we must first look at the foundation built between 2009 and 2022. Following 2008, global central banks, in their attempt to stimulate growth, introduced the era of ZIRP, or zero interest rate policy. This was financial heroin for the housing market. Debt became essentially free. Money rushed out of low-yielding savings and into hard assets, driven by the belief that housing was a one-way bet. Governments subsidized this belief, and borrowers, even high-quality ones, were incentivized to take on massive leverage because the cost of borrowing was negligible. This decade-long experiment created the everything bubble, but its epicenter was residential real estate, pushing prices in major global cities to historic multiples of average income levels, unseen since the run-up to the 1929 crash. This wasn't just an American phenomenon. This was a global, synchronized addiction to cheap credit, and its consequences are now universally manifesting. What makes this crisis different from 2008 is the shift from localized subprime to global synchronization. In 2008, the crisis was contained to complex derivatives in the US. If you lived in Canada, Sweden, or Australia, you were hurt by the ensuing recession, but your local housing market might have remained relatively stable. That stability is gone now. Look at the data. House prices in Toronto, Sydney, Stockholm, and Vancouver all rose together, fueled by the same global flood of liquidity. And most critically, many of these markets, unlike the US, which heavily uses 30-year fixed mortgages, rely heavily on variable rate or short-term fixed-rate mortgages. When the US Federal Reserve, the Bank of England, and the European Central Bank simultaneously hiked rates at breakneck speed, they didn't just affect their local markets. They created a global interest rate shock. Millions of homeowners across multiple continents are now confronting a refinancing event where their monthly payment is not 2% or 3%, but 6% or 7%. This shock is a direct, unavoidable default trigger, not localized to the poor-quality borrower, but targeting high-quality borrowers who simply took on massive principal when the cost of servicing it was zero. Let's be brutally clear about the scale. The total estimated global residential mortgage debt today is nearly 3 times the size of the debt pool that triggered the 2008 crisis. We are talking about tens of trillions of dollars that are now highly sensitive to interest rate movements. Furthermore, housing has been utterly financialized. Unlike 2008, where the debt was packaged into complex securities and sold to banks, today, institutional investors, private equity funds, and investment trusts have aggressively purchased single-family homes, turning housing from a societal necessity into a pure investment asset class. When prices fall, these institutions will be forced to sell to meet liquidity demands, creating a cascade effect that floods the market with inventory and drives prices down further, far faster than individual homeowners selling organically. This is the new architecture of the collapse, a massive, interconnected, highly leveraged global housing asset class. But the final terrifying reason why this crisis will be bigger is the lack of government firepower. In 2008, governments had 2 tools. They could drop interest rates to zero, and they could initiate massive fiscal bailouts since the balance sheets of many nations were relatively healthy. Today, those tools are exhausted. Interest rates are already being pushed down from decades-high peaks, signaling that central banks have limited room to stimulate. More importantly, governments across the G7 are already carrying massive sovereign debt loads, debt accumulated from COVID stimulus, ongoing geopolitical conflict finance, and years of deficit spending. When the next financial institution or market segment requires $1 trillion bailout, where will the money come from? It must come from even more borrowing, which translates directly into further currency debasement and inflation, the very crisis we are fighting right now. We are heading into this major housing crisis with an empty fiscal holster, paralyzed by the previous debt cycle. The interconnectedness is the problem. The housing market is where credit, monetary policy, and personal solvency all intersect. When the global housing market corrects, and the high interest rates guarantee it will hit highly indebted economies simultaneously, and the sovereign balance sheets are too weak to absorb the shock. If you find this structural, unflinching analysis of global financial risk essential to your understanding of economics and your personal strategy, then I urge you to subscribe now. By subscribing, you join a community dedicated to recognizing these systemic risks and arming ourselves with the strategic foresight necessary to navigate the volatility of the coming debt crisis. The housing debt is immense, but there is one other colossal invisible debt anchor holding back the economic potential of the next generation. Join us next time as we dissect the financial weight crushing the younger workforce, making homeownership impossible and consumer spending unstable. We will decode the silent, colossal weight of the $1.7 trillion anchor, how student debt is choking the next generation's economy. You will not want to miss this crucial examination of youth insolvency.